The foundation of this system, and its most powerful driver, starts with debt. The debt trap is not just a theory, it's built into the numbers. In the US, total public and private debt sits at nearly 370% of GDP. That includes everything: government, households, and corporations. When debt grows faster than the economy, the math breaks down. At a certain point, paying the interest alone becomes unsustainable. For example, if public debt yields rose to 5%, interest costs would quickly outpace the economy's 2% growth rate. There's no way to pay down the burden with traditional means, so policymakers are forced into a corner. The response is always the same. Central banks suppress interest rates and expand their balance sheets. Since 2008, the Federal Reserve's assets have exploded from $900 billion to $8.9 trillion. This expansion isn't incidental. It's closely tied to asset price inflation. Over the same period, the S&P 500 rose by 700%. The pattern holds globally. In Japan, the central bank now owns half of all government bonds, maintaining zero yields since 2013. These actions aren't about stimulating growth. They're about managing the impossible math of high debt. Financial repression is the byproduct. Savers see negative real returns year after year. Even when nominal rates rise, inflation outpaces them. On average, cash has delivered real returns of negative 1 to 2% annually. This is not a market failure, but a deliberate policy to shrink debt burdens in real terms. The cost falls on those holding cash, while borrowers and asset holders benefit. Over time, this creates a steady transfer of wealth away from savers. The effects bleed into every asset class. As cash becomes toxic, investors are pushed into stocks, real estate, and alternative assets, not because fundamentals demand it, but because they have no other choice. Home prices outpace wage growth. Stock valuations disconnect from earnings. These are not isolated bubbles. They're symptoms of a system under pressure to keep debt service manageable. This cycle is reinforced by the need to refinance. Governments must roll over trillions in maturing debt every few years, creating predictable liquidity crunches. The U.S. Treasury alone will refinance $7.6 trillion through 2024. Each time, the pressure mounts for the Fed to remain accommodative, regardless of broader economic signals. This locks central banks into a posture of perpetual easing. The result is a predictable rhythm. Debt grows, central banks respond, asset prices inflate.